We plan for weddings, we plan for college, we plan for retirement, but we don't plan for long-term care, even though it's one of the most expensive phases of life. My hot take this week: long-term care isn't a what if, it's a how will we pay for it. Most Americans are one diagnosis away from watching decades of savings evaporate. And it's not because they failed, it's because the system was never built to protect the middle class. If your financial plan doesn't include care, it's incomplete. This week's questions, we're asking, if most Americans don't have long-term care insurance and Medicare doesn't cover long-term care, what is the actual plan for funding care in retirement? When does it make sense to transfer financial risk to a long-term care insurance policy? And when does home equity become the more realistic option? Welcome to the Aging Together podcast. I'm your host, Dr. Pooja Ashok Patel, a double board certified occupational therapist and gerontologist with additional certifications in dementia and fall prevention. This season, we are unfiltered. In this podcast, I interview guests who are experts in their fields or caregivers who are sharing their lived experiences. Let's meet today's guest. Today I'm joined by Kevin Guttman, senior mortgage broker, reverse mortgage specialist, and a 4-time Amazon bestselling author. Kevin brings a wealth of knowledge, integrity, and a people-first approach to the world of senior home financing with a deep commitment to help senior homeowners understand their options. Kevin, thank you so much for joining me.
Thank you, Pooja. It's great to be here.
Absolutely. We are tackling a topic that we haven't had on the show yet, and so we'll get into the super specific details of it as we start talking about it. But before we get into that, do you have a hot take or a very strong feeling about something related to the topic?
Yeah, I agree with your hot take. And the one thing I would add is one of the ways people can pay for long-term care, either bring it in home and tap the equity to pay for somebody to come in, or you mentioned leverage a life insurance policy with a long-term care rider to where they're shifting the risk away from themselves and their estate and their heirs to the insurance company. So we are on the same page. We're going to have a great discussion because it is a huge need among Americans. And I think only 12% of people have some type of long-term care. And for a lot of people, like you just mentioned, one event can wipe them out, take out their assets, take out any money they were planning to leave their heirs. So it's a big deal, and I'm really glad we're going to talk about it today.
Yeah, absolutely. You said something that I'm actually not familiar with. You mentioned something about shifting responsibility from self to insurance company. Can you talk a little bit about that? What are you referring to?
Well, it's interesting. You think about it. Throughout our lives, we have health insurance for health needs, auto insurance to cover our cars, homeowners insurance to protect our homes, disability. If we get sick and can't work, then we can get paid through the insurance company. So long-term care makes sense as people get older because they may have a significant medical event that can cost hundreds of thousands of dollars. And how are they going to pay for that? On top of Medicare, right? So they're going to have to pay for that out of pocket. But they can get a life insurance policy with a long-term care rider, and they can shift the risk away from themselves and their estate to the insurance company. So they, just like any other policy, they pay a premium, but they get this huge benefit that can cover any need that they have. So I'm surprised only 12% of people really have something in place. And like you mentioned in the open, we plan for all kinds of things, and this is something we should really plan for.
Yeah, that makes a lot of sense. I wonder, lately I feel like there's been more education and awareness around long-term care policies, like insurance policies. And what a lot of people are finding out is that sometimes it's a little too late to get into one at a reasonable rate. And so in your experience, around what age range have you seen is the right time to get into it?
Yeah, you're right, because it's not just our dollars that pay for long-term care, it's our health. Mm-hmm. A good time to consider it is when somebody gets into their 50s, maybe 55, but they can get it up until age 79. Is the health going to be there for them to qualify? And then, of course, the longer you wait, the more expensive it is. So sooner is better, especially when you're healthy, because we don't know what tomorrow's going to bring. It's not just our dollars that pay for it, it's our health.
Yeah, I think that's really good to know. Do you know if, so let's say, if someone at 40 opts in because they're planning ahead and they want the lowest expense premium possible because they're young and healthy and they start paying into it, Does that compound, and how does that result in coverage when they need it versus someone who opts in at 60 and they have a couple health issues and then now all of a sudden they need access at like 70, 75? Because I've heard that also where some people say they paid into it for years, but then when it came to them actually needing the coverage, they couldn't use it because it hadn't vested yet.
Yeah.
What does that look like?
So, it's interesting. Over the years, programs have changed. There used to be strict, or not strict, but there used to be specific long-term care insurance policies. Those are few and far between anymore because they're so expensive. But what we're seeing now is more of these hybrid policies where it's a life insurance policy with a rider tied to it, which can be used for critical care or long-term care event. And you're right. And if somebody buys insurance at 40, it's a lot more affordable than at 60. But you can only buy so many years, right? 25, 30, 35 years. So the thing about getting it in your 50s is most people live 82, 83, or 85 maybe. So if somebody gets at 50, they get a 35-year term. They're going to have enough coverage to cover them during that period. Or they can get a permanent policy and also have a rider to it where there's no expiration, can go to age 100, even 120 in some cases. How it used to be, people used to purchase long-term care insurance policies. Now it's more hybrid, where it's a life insurance policy and a rider's tied to it. And then they can exercise that if they have a need or an event that triggers it. So I hope that answers your question, but they've evolved over time, I guess is what I'm trying to say.
Yeah, definitely. I think that's important for people to understand how much they've changed over the years. And now if you're trying to look for something in the market, it's really hard to find an actual long-term care insurance policy. And you're likely looking at life insurance policies with those riders, like you said. And then within those riders, talking about or looking for what actually it covers, right? Like, does it cover your care at home? Does it cover care in an assisted living facility? Does it cover paying someone to come take care of you? I think there's a lot of nuance there when it comes to care as far as what it's going to cover.
And then there's policies, like one my wife and I have is we bought a policy that either of us can use. And we bought so many days at a certain level of care, and we can start at home. So you're right. I think what people are looking for is the flexibility. And anymore, if you get insurance specialist who specializes in long-term care and understanding that and has access, like I prefer to work with brokers because they don't just represent one company, they represent several companies. Then you're just going to get so many more options that they can tailor to meet your needs and make sure it's going to be what you need as you age.
Yeah, absolutely. I think insurance brokers across the insurance industry, right, from home insurance to, car insurance to health insurance, working with brokers goes a long way because they can present you with something you're actually looking for instead of selling one specific policy. So I do agree with that. I think in this case too, it's probably a good thing to work with a broker to find the right fit for you.
Absolutely.
We mentioned that at some point it just becomes too expensive and might not be the right coverage. Let's say someone's at 60, 65, now they have a debilitating disease or they have multiple diseases. Life insurance with long-term care insurance is unlikely to be a cost-effective method of care. And it's unlikely to provide the level of care that they might need in 10 years from then. Other alternatives to that, one of the things you mentioned when we talked was reverse mortgages. Now, I know little to nothing about reverse mortgages. So walk me through what is a reverse mortgage or a retirement mortgage, or how does that work?
Yeah. So it's just like any other mortgage, except there's a few differences. One, a monthly payment is optional, not mandatory. Second, it's a non-recourse loan. What that means is that no debt can be passed on to the borrower, their heirs, or the estate. The only recourse the lender has is against the sale or refinance of the home. And then the third one is if you have enough equity, your house can start paying you each month. So what some people do is they have a house free and clear, they own it outright, tap into the equity, and they use that money to pay for care to bring in somebody to help with the daily activities of living. So somebody needs help bathing or dressing or cooking meals or cleaning or transporting or whatever. They have somebody come in 2 or 3 times a week for a few hours a day, and they help them with these daily activities of living, and they pay for it through the equity in their home. So I would call that self-insuring because like your example just said, maybe they can't afford or can't qualify for life insurance with long-term care rider anymore. So now they have to self-insure. They have to pay for it out of pocket. Somebody that can come in and help them just continue to live their life, maintain their independence while they live at home. And a reverse mortgage may be a way that they can fund that. Because think about this, Pooja. There's only 3 ways people can access their equity. Sell your home, do a cash out refinance or home equity line of credit, have a monthly payment, or do a reverse mortgage where your monthly payment's optional. You don't have to have a monthly payment if you don't choose to.
That's really interesting. So who qualifies for, are there qualifications, criteria to be able to even qualify for a reverse or retirement mortgage? And then 2, what does that process look like? Is it similar to refinancing or getting a HELOC, or is it completely different?
Yeah. So for the traditional reverse mortgage, which is what 90% of them are across the country, backed by the FHA, somebody has to be 62 years or older. How about 65 to 70% or more equity in their home? It has to be the primary home. They have to maintain it, pay the property taxes, the insurance on time. As long as they do that, the term of the loan is 150 years. In other words, they can't outlive it. Nobody lives that long. Now, the second part of your question, how do they qualify? Most people qualify with just their Social Security, or if they're still working, their earnings, because they really only have to prove they have enough money to pay for the property taxes, insurance, and maintenance on the home. And that's a lot easier to qualify for that than a full mortgage payment with principal and interest. So what we're seeing is people are realizing that they do need to address this specifically with long-term care. I think it was Fidelity who did a study recently and said the average 65-year-old healthy couple is going to spend $315,000 out of pocket for medical expenses in their lifetime. Well, how do you pay for that? One is you can tap into equity, or 2, like we talked about a minute ago, shift the risk away from yourself to the insurance company.
Yeah, you're giving me a lot to think about here, because I do work with a lot of families who run out of options, and it's very much of a push and pull of, can we get them on state Medicaid for coverage? Can we figure out some sort of liquidation? Or usually the default is selling their home, but then that comes with its own stipulations of then where are they going to live? Who's going to pay for that? How, all of that stuff.
And Medicaid, just so it could say something real quick.
Yeah.
They have a 5-year look back, a medical. Yeah. So somebody can spend down their assets, but the state government's going to look 5 years back and recoup whatever money they're going to pay in Medicaid from that spend down. And then your other point is they have to live somewhere. And I always ask the heirs, the kids, I say, well, can mom and dad move in with you? Or are you in a position financially to help mom and dad? Or can you stop your job? Can you quit your job and become the full-time caregiver, right? And usually it's no, no, no. So then to your point, they have limited options. But if somebody can tap into equity, we all have 3 buckets of money: our wages, our investments, and our equity. And when people tap into equity, it allows the other 2 to last longer.
Yeah, I think that really owns in on the importance of having equity. I think it's really hard in today's economy to really consider how many people have equity with like the decline in home ownership and just generational changes. However, for these elderly, primarily baby boomers at this point, who have homes and equity and everything like that, it could be a game changer as far as options go. Does that threshold so I know you mentioned you just have to prove that you can afford those maintenance costs, but is there any other income threshold or stipulation associated with it?
Well, there's not. And to go back to Medicaid for a second, with Medicaid, they can't have more than $2,000 in their bank accounts. And so sometimes people are concerned about that. And one of the things I point out is whenever you access equity, whether it's a traditional mortgage, cash out refinance, HELOC, or a reverse mortgage, that money is not considered income. Loans are not taxed. Income is taxed. So when people tap into equity, it's not considered income. Now, we want them to be wise. We don't want them to overspend or to have too much money in their account where Medicaid could question it. So we coach them, don't have more than $2,000 in there. But the point is, As people get older, if they don't have equity, they have very limited options.
Yeah, definitely. I'm trying to think. I think one of the concerns sometimes with this is that they can't lean on it as an asset anymore, but that would still be considered their own asset, right?
Correct.
Yeah.
A home is exempt from Medicaid.
Yes, yes. Your primary residence is, which is why this is so interesting to me, because I think it just opens up so many more doors for those who don't qualify for Medicaid and can't afford long-term care but have equity, have a home, and could potentially use this to continue to get some level of care.
Yeah. So one of the reasons why people are reluctant to consider a reverse mortgage is from 1961, the very first reverse mortgage was taken out in 1961. From 1961 to 1988, these loans were not regulated. So it was kind of like the Wild West. Different companies had a version of a reverse mortgage. And in some cases, Pooja, people got taken advantage of. They lost their homes. So that's the number one thing we hear from people is, I know I have to sign over the title to my home. That is not the case. That hasn't been true since the government started regulating these through the FHA 1988. You still stay on title just like your mortgage now. You're on title. There's a lien against your property. Same thing. The difference is there's no mandatory monthly payment required with a reverse mortgage. And if you have enough equity, you can tap into that three different ways: lump sum, monthly payments paid to you, or a line of credit that grows by compound interest. It's insured, and all that equity is protected from any market correction. So it's really smart for people to look at it. And I always say to people, at least explore it, at least understand it, at least know it's available to you. Whether you ever do it or not, it's good to know what options you might have.
Yeah, I think that's great. Is there eligibility as far as what type of home? Like, does it have to be a single family home, or can it be a townhouse?
Yeah, good question. Single family home, townhomes, condos, 2 to 4 unit buildings, as long as the borrower occupies 1 unit. Manufactured homes built after June 15th, 1976 also qualify. So those are the properties that qualify as those types.
Really good information. I'm hearing a lot of advantages to this. Are there potential drawbacks or risks to consider with reverse mortgages?
Yeah, so we always ask people, how long are you planning to stay in the home? And if they're not going to stay at least 18 months or 2 years, that's probably not going to make sense because they're not going to recoup the cost of the mortgage. Another one would be, if they really haven't managed their resources well, you've probably heard about people winning the lottery, and 2 years, 3 years after they win, they're worse off than when before they won the lottery. Same thing with this, because they're going to have access to a lot of money. We don't want to put them in a worse situation than they are currently. Or occasionally, this hasn't come up very often, but occasionally you have a family member that's pressuring them to get a reverse mortgage so that they can get their hands on the money. When it's the parents or the grandparents who really need it, it's not the kids or the grandkids. So we try to watch for that they're not being taken advantage of. Sometimes there's a romantic interest that is trying to pressure them to access their equity, and then that person disappears after they get their hands on the money. So we try to have our antenna up and listen for those things and protect people. I will say this, Pooja, the safest mortgage anybody in America could get is a reverse mortgage. There's lots of safeguards built in. For example, they have to do a counseling appointment by a third party. The fees are capped and set by HUD and state governments. They can only borrow so much, even in the first year, because of that thing about people being worse off winning the lottery, that kind of thing. So there's lots of things the government has put in place to make them safe for seniors and to make sure they're not taken advantage of.
And I imagine this would fall under if, let's say, an older adult has a financial durable power of attorney, that power of attorney could potentially use this option to pay for the care that they're paying for the elder.
Yes, we can close with a power of attorney. We can close with in a trust. Obviously, we just need to document all of it, but yeah, that happens all the time. People close with a trust or with a power of attorney for various reasons. Maybe somebody just wants their child to be involved in the financial decisions, or maybe they have a medical situation going on and they don't know their mental faculties, so they have somebody helping them with those kinds of things. So yeah, that's all acceptable for sure.
Yeah, I think, the case I see the most frequently is when a parent starts demonstrating signs of dementia or gets diagnosed with dementia. And my big job is to make sure they have powers of attorney. That's like my number one excuse me, my number one task item for them to make sure they have, usually when I'm talking with them from there on, because then I can have discussions with that power of attorney and figure out plans and options and things like that. And I think that's where this could be something to consider, and encourage them to meet with a broker to be able to consider what their options might be, see what it might look like, see if it's a good option for them, because then the child can use those funds to provide the care.
Yeah,
And I think that's where that connect gets lost.
I agree. And I always tell people there's really four decisions you need to consider when you're thinking about a reverse mortgage. The first is this the right time? So I always say the soonest you qualify, you should look at it. You should consider it. Because life can change. Here's an example. Back in 2020, 2021, we had historic low interest rates. Well, in 2022, they went up rapidly. People that chose to wait came back in 2022 and said, okay, I want to do it now, but the interest rates have gone up, higher interest rates mean lower borrowing power, and now they didn't qualify. Or maybe their income changed or their life situation changed, lost a spouse, and now they don't have enough income to qualify. So the soonest you qualify, you should look at it. That's the first one. The second one is this the right program? A reverse mortgage is the only mortgage where a payment's optional and you can access equity. And so if that's what somebody needs, i.e. more cash flow, more money in retirement, a reverse mortgage may be a good option. The third is, are we the right company? What company are you working with? So I work with a company called C2 Financial. We're a large broker out of San Diego, California. We're the number one reverse mortgage broker in the country. Nobody closes more reverse mortgages than us as a broker. And we work with, there's only 16 lenders that underwrite the paper on these. We work with about 12 of the 16. So we have lots of options for people. We do have options for people who want a mortgage with a payment. So the bottom line is have options. And then the fourth is, am I the right guy? So I always tell people, I know I'm not everybody's cup of tea, but I have written 4 books specifically on this topic on Amazon. I'm one of 220 people in the country that is a certified reverse mortgage professional, which means we've passed a rigorous test that only 25% of people pass. We commit to a code of ethics. We have enough experience to sit for the test, and we commit to continuing education. There's only 220 in the whole country. So you want to find somebody who knows what they're doing, is going to have your best interests in mind, and isn't going to take advantage of you, and is going to be able to educate you on your different options.
Yeah, I think that was really helpful, because I think one of the other things that we talk about in the healthcare space a lot is how to know that you're looking for the right professional, because there are so many variations of certifications and degrees and job titles, and it can get really difficult for a layperson to say, who should I be looking for? And I think they just search for broker and they're going to get a million responses. And so I think similar to how we say, you want to look for someone who's dementia certified, you want to look for someone who's skilled in working with the older adults, right? So in your case, we want to look for a certified reverse mortgage specialist.
That's what I would do.
Yeah, definitely. I mean, I think it gives me a lot to consider too, just in general, not just for my families that I work with, but also for my own family. And for as we start thinking about this, right? I think one of the generational differences in caregiving that we're seeing is, yes, the children will take care of their parents, but it used to be hands-on physical assistance, and now it's turning into more financial assistance. We're going to hire out the care because we don't have the time or the energy to be able to do that, or the flexibility to be able to do that, but we have the finances to support that. And if we don't need to use our finances and have access to their finances, then we could help them cover their own care, right? And so I think that's where I see a lot of shifting pieces, and this seems like a really good alternative for people who can't afford it and don't qualify for Medicaid.
I agree.
I know you mentioned the myth about people thinking that you have to turn over your title. Are there any other myths or misunderstandings about reverse mortgages? And I think just what are your thoughts on the general awareness of this or poor awareness of this because like I said, I've been in this field for a while, just working with older adults and helping them figure out their options for care, and this is not something that I'm personally very familiar with, and even that's with me doing the work. And so I'm curious on your thoughts around why it's not well known, and then also any other myths or misunderstandings that you've heard.
Yeah, first, the government's terrible about promoting their programs. They're not very good about getting the word out. Second, there is that carryover from 1961 and 1988 where people did turn their title over, their house over to the lender. But another one is, you have these experts out there, Dave Ramsey, Susie Orman, who speak against them, and they're misinformed. They're not trained, they're not licensed, and they don't really understand how they work. And so, a lot of people listen to these people and think, well, Dave Ramsey says it's bad, it must be bad. Versus doing the homework yourself and learning about it yourself. The number one thing I hear from people, Pooja, when I meet with them and explain the program is, wow, this sounds too good to be true. What's the catch? Mm-hmm. Here's the catch, if there's a catch. It's a deferred interest loan. So you're not making a payment, but you're being charged interest against your equity. So one of the downsides, we touched on some downsides a minute ago, but one of the downsides is there's going to be less equity for the heirs. So it's kind of like the child who got upset with his mom for getting a reverse mortgage. And one of my colleagues was talking about this. He said, well, did your mom have a 401? He goes, yeah. He goes, what happened to that money? Oh, well, she spent it to live on. Okay. So then what other resources did she have? Well, she didn't have anything else, but she was short every month on her budget. So she got a reverse mortgage to help eliminate the payment and have money available to her if she needed it. He goes, well, were you in a position to help her financially? No. Well, could she have moved in with you? No. Well, what did you expect her to do? What options did she have? She wanted to stay in her house. 91% of people want to stay in their home. They don't want to move. So a reverse mortgage is designed for a senior who wants to stay on title, wants to maintain their independence, wants to entertain the lifestyle they've dreamed of and worked for, doesn't want a monthly payment, wants access to their equity if they need it. Pooja, life hits everybody, right? And I live in Colorado. We get hailstorms and people have to replace their roofs. Well, that costs money. People get sick. Medicare doesn't cover all the expenses. They got to pay for that. They need a new car. They want to help their kids or their grandkids. Life just keeps coming. So the more money people can have available to them, the better, the higher quality of life they're going to have in their golden years. Is worrying about whether they can afford their meds or not. I'll tell you a quick story. The very first lady I helped was referred to me by a client. It was her mom. And she's 84 years old, 5 foot nothing, full of fire. And I asked her, I said, hey, Carm, how's this going to help you? She goes, well, my budget's tight. I'm like, I get that. A lot of people have that same situation, fixed income, right? She lived in a duplex, the rent paid for the mortgage, and then she lived on Social Security. So I said, well, tell me a little bit more about that. She goes, well, to be honest, I have to use credit cards to buy groceries. Going to the grocery store, I got to use credit cards. I don't have enough money. So at the closing table, I'm doing the math. I know no more mortgage payment, pay off the credit cards. It's close to $1,200 a month, not quite. And so I know the number. But I say, hey, Carm, I know the math, but how is this going to help you? She kisses me on the cheek, and she says, well, now I don't have to worry about money anymore. I can sleep at night. And I'm like, man, I'm in. If I can get kissed at closing every time I help somebody, I'm in. Had to go home and tell my wife I got kissed by an 84-year-old gal at the closing table. But the point is, these loans can be game changers for people. And in fact, I brought some clients into the radio studio. I was going to do some radio spots. A reverse mortgage changed my life was the theme. And I left in tears just hearing their stories of how it changed their life. And I ended up writing a book. A reverse mortgage changed my life. Just stories from my clients of how reverse mortgages have helped them. And every time I talk to one of them, or I see them out in the community, or I talk to them, they always tell me, you have no idea what this has done for me. This has helped me so much. So really, that's what we're trying to do. We're just trying to help people have a better retirement, enjoy these years, not worry about money, pay for care if they need it, and they probably will. So yeah, that's really it in a nutshell.
Yeah. I think it's wonderful that you've had so many great stories that you could share to really highlight the benefits of a reverse mortgage. And I think that that's helpful for people who might be at an odds, at their ends of trying to figure out what their options could be. Something you mentioned earlier kind of made me think about a personal opinion that I have on just the entitlement of kids for having access to their parents' properties after they die. And I just think like this is one way to one, get rid of that entitlement, I think, and then two, also not have to think about which kid gets the house. I mean, you might as well live off of your own equity and use it for your own needs and not have to worry about your kids.
Yeah. Less than 1% of kids want their parents' house, but they do want the equity. It's true. Another myth, I didn't finish that question you asked me earlier. Another myth people have is, well, I must be a loser because I need a reverse mortgage. It's like a last resort. But the truth is, we're seeing people that quote unquote don't need them get them because they want to unlock that equity now. They want to start giving that money away now while they're still alive to help their kids or their grandkids or their favorite charity. They want to see the money doing good now while they're alive. So it's not just for people who haven't saved enough or haven't managed their money well enough, kind of a last resort thing. Well, I'm broke, I better get a reverse mortgage. We're seeing people be more proactive and saying, no, I want to get it because I want to do good with the money now while I can see the good that it's doing. So that's another myth we see a lot of times is it's a last resort kind of thing.
Yeah, I think that pairs well with people just don't understand how expensive care is. When you're looking at hiring, even support at home for a few hours a day can easily be, anywhere from like $1,200 to $1,500 a week. And then if you're looking at supportive living environments, assisted living, I mean, that's just up to 5 digits, right? Per year or per 6 months. I mean, the cost is endless. And so I think that pairs with a lot of that mentality of not realizing just how expensive long-term care is.
Yeah, I agree. And it's only going up. It's going up much faster than inflation. And there doesn't seem to be any end in sight. I've heard somebody float the idea of, well, there's going to be robots that can take care of us. But, we want a human touch, right? When you get old, I think anytime, you don't want a robot taking care of you. You want a person taking care of you.
Yeah.
I don't know that that's a realistic thing, but, that it just shows you people are trying to figure it out, right? Because it's so expensive. They're trying to find a way. I think the smartest way is to either pay for care or through equity perhaps, or to get a policy in place when you're healthy and young enough to shift the risk away from you and your estate to the insurance company.
Yeah. Well, Kevin, I think this was super insightful. I learned a lot, which at this point sometimes is hard because I'm like, I've been in this so long. I feel like it's hard to find new information. And I think this was incredibly eye-opening for me. And I'm hopeful that a lot of listeners will learn something from this as well.
On my website, I've got some great resources, articles and podcasts and videos, and a consumer guide that I wrote that people can download for free, reversemortgagerevolution.com. Again, it's important just learn about it, whether you do anything or not. Learn how it works. Learn if it could be an aid to you, help you, and pass it on to your kids if they want to be in the know, or your advisor. A lot of advisors don't understand reverse mortgages. So what's happening is it's starting to gain more traction, more popularity. And so we just want to be sure people know it's available. And if we can be a resource for people, we're happy to do it.
Yeah, I think that's great. We'll put your link website in the show notes so people can access it very easily. And I thank you so much for your time today and sharing this knowledge with us.
I enjoyed it so much. Thank you for having me.
Absolutely. Thank you for listening to the Aging Together podcast. If today's conversation helped you, please follow the show, share it with a friend, or leave a quick rating or review. Your support keeps this podcast free, ad light, and growing. Until next time, let's keep learning and aging together. Take care.